There's a product that investors are using more and more now to secure that investment property they have their eyes on. Find out what that is and how it all works next with Bill. Welcome into the Smart Mortgage Show. Great to see you again here on the channel. If you have a comment, leave one for us. We'll check those out. Also, subscribe if you haven't done that here on YouTube. But Bill, talking about a product, as I mentioned, that investors have been using more and more about this. You gave me the DSCR is how you described it to me. Now, I've never heard of this. I'm going to let you explain it a little bit and we'll dig into it.
Yeah, so DSCR, it stands for Debt Service Coverage Ratio. And then the easiest way to look at it is in residential lending, which primarily is what we do. We help people to buy primary residences or investment properties. But this is for like someone who's not like an expert investor. Everything's based on standard underwriting guidelines, meaning for the income side of the equation, they want to look at your job and where you work and how much money you make and plug in all your personal debt and plug in all your personal income and, use some rental income from the rental property, put it all together like standard underwriting and decide if you qualify. So what we now have in the residential side of lending, and by the way, commercial lending has largely looked at things this way for a long time, but now it's come into our space that we can offer products that are more like the commercial broker or lender and base it off of a debt service coverage ratio. Simply what that means is if the mortgage payment on the house is $1,000 a month and the estimated or actual rent payment is $1,000 a month, then that debt service coverage ratio equals 1. Okay, so that means that the rents cover the mortgage payment, and that's good. We like the ratio to be 1. If the ratio is 1 to 1.15, a certain interest rate is assigned and offered. If, let's just say, for instance, the mortgage payment is $1,000 per month, but you're actually getting $2,000 a month in rent. Well, now we've got way more rental income that is needed to cover the mortgage payment. That debt service coverage ratio is 2%. By the way, that's not really common, but for illustrative purposes, that would yield a better interest rate because it's less risky to the lender. Alternatively, let's just say that we had a debt service ratio where the rental income coming in was $500 a month and the payment in all of these examples we said was $1,000 a month. Well, now the rental income is only half of the mortgage payment. So it would be a 0.5% DSCR ratio. Now the lender is going to say, some of them are going to say, we won't touch that. That doesn't make sense. It does not debt service. Other lenders might say, we'll do it, but we're charging a premium. You're going to pay extra fees at a higher interest rate. So all of these scenarios, though, the property itself is showing its ability to cover the monthly mortgage debt.
So when you, and again, these are all questions I'm about to ask coming from a complete novice. So excuse me if I'm asking questions that are pretty obvious or well known, but I guess the first one I would have is how do you pull those rent numbers, Bill? Is it just looking at historical rentals? I mean, how do you know, or is it something that has to be signed and agreed upon already? How do you find that number?
It's a great question. So the rental income numbers are either going to come from an appraiser because we're going to need an appraisal. And on this product, the rent schedule, the comparative rents in the area becomes central to the underwriting. Very important. So we're going to see what are other properties in that property's vicinity. How much do they rent for? So that's one component or one way to see what our subject property is going to yield in monthly rents. The other option is Is there a lease on the property currently? What's the history of rental income on this property from an active live lease? So one of those options, sometimes a combination of those options, are how we determine the rental income.
Okay, good to know. We're talking about the debt service coverage ratio, a product obviously that Cross Country Mortgage offers. If you want to learn more, obviously get in touch. Text Lynn to 21,000 to begin talking with Bill and discussing this. Is this for any type of investment property, Bill? Does it lean more towards commercial real estate? Would it work for me if I wanted to buy a condo on the beach and it had a good rental history? Would it apply for that?
Yeah, so this could apply for a condo on the beach. This could apply for a multi-unit property. This could apply for lots of, it covers a wide range of property types. Now, really important part of this, Ben, is it's got to be a rental property. So we see people trying to sneak one through where they don't qualify to purchase a primary residence because there's no rental income to help with their income. So they actually apply for this loan and say it's going to be a rental, take advantage of the rental income that we develop using the rent schedule from an appraiser. And that makes everything work from a debt ratio standpoint, but they're not really going to live there. So the underwriting process looks really heavily at, well, do you already own a primary residence? Because if you don't, buying your first property as an investment property, we're going to look harder at that. You can do it, but we're going to look a little harder at that to make sure that this is truly going to be a rental and not a house that you just said would be a rental so you qualify and now you're going to live there.
Is that something that happens often, or is that? I mean, it seems like that would be fairly obvious, but is that something people try to do?
It is now one of the more common types of mortgage misrepresentation or mortgage fraud that is out there. So underwriters and lenders are eyes wide open on this, and they're going to scrutinize this heavily. And by the way, they should, because the buyer of this property, the borrower, is not demonstrating an ability to be able to make the payment. What they're demonstrating is somebody else's ability to make the payment through rental income, which is not going to be there. So I don't know this for sure, but I'll bet if you looked at portfolios of these loans and the people that they've identified as not going to live there that tried to use this this workaround, the default rate's got to be quite high.
All right, very interesting. Well, again, if you want to learn more, text the word Lynn to 21,000. Again, Lynn to 21,000. And is this something, Bill, that typically people kind of are aware of coming in to meet with you, or is this something that usually you bring up to them and introduce during the process?
Yeah, so this product, we will bring it up a lot because people are not yet familiar with it. And I'll give you a really great scenario. I literally just had somebody close on a DSCR loan this morning. They purchased an investment property. It was around $1 million. They borrowed $700,000. They had great credit. They're putting 30% down. The rate for the DSCR was very similar to what it would be with Fannie Mae and Freddie Mac. Big detail here is, on a commercial loan, the rate's fixed for 5 years, and after 5 years, you have to refinance. On this, we offered them a 30-year fixed rate note. If rates go up, they're protected. We got them the same rate that you would get on a standard underwrite, but the underwriting process was really simple, and they were able to put the loan and the property into an LLC, which Fannie Mae and Freddie Mac do not allow. So they got all the tax benefits, all the legal protections, all the rate and term benefits, and a much simpler process, all wrapped up in the DSCR product. So in this scenario, it worked beautifully for the customer. They are thrilled. And the financial benefits to them, they're going to reap the benefit of for years to come.
Very good stuff. Good. Thanks for sharing that, Bill. And hopefully this maybe gives you another option, something else to think about if you are, looking to buy an investment property. That DSCR, ask about it when you're going through that mortgage process, and feel free to reach out to Cross Country Mortgage. This is what they do. They help you find the option that best fits you and what your goals are moving forward to make sure that you have the best financial fit, not just something that you'll qualify for, but it actually is the best fit for you. That's what they do at Cross Country Mortgage. You can get in touch. Just text the word LEND to 21,000. You can also check out smartmortgageshow.com. Thanks for being with us, Bill. Thanks as always for the insight. Talk to you again soon.
Thanks so much.
This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.